Well, for a deeper look at investor anxieties, let's bring in Hatem Dhiab. He's managing partner at Gerber Kawasaki, a wealth and investment management firm. Welcome back to the show.
Hi, Rochelle.
So given how blindsided investors were at the collapse of WeWork, can we expect more scrutiny from investors when it comes to some of these buzzed-about companies?
Oh, absolutely. I think it's not just more scrutiny. I think people are just outraged. You're seeing basically a company that had a $47 billion valuation and for really nothing to speak of, and it's all fueled by Softbank and really air, if you want to call it. So you're going to see us, investors are just asking a lot more these days.
So then, given all the issues that were unearthed about WeWork, how much of a reckoning is this for Softbank, who came to their rescue?
I mean, it's all, Softbank has created this problem, and it's going to cost them billions of dollars in losses. So it's definitely, they are definitely the biggest losers. But I hope this will be the end of an era where these companies or these startups can raise ungodly amounts of money just to grow without really having a real business model that's gonna work, or at least it's gonna show profitability eventually.
So then, to that point, how can startups avoid following in WeWork's shoes in terms of finding more balanced and feasible valuations?
I think the one important thing is really they have to have a path to profitability, right? You have to have a business that is going to make money eventually. You can't have a great idea or flashy idea and hope that you're going to grow and get more money and grow more and never show profits. That's the problem with WeWork. That's the problem with a lot of companies out there, such as Uber and Slack and so forth. So that's where CEOs and founders have to focus on, really.
And we certainly saw poor early performances from Uber's IPO and some of these others last year that we're still waiting to see be profitable. How are the big banks responding to 2019's IPO flops and disappointments?
I mean, JP Morgan, Goldman Sachs, they all enabled these IPOs. They basically were the reason why this story happened or WeWork happened. So the conflict of interest that exists is really the problem here. So I think what you're going to see is you're already seeing this, is a lot of companies are looking at direct listings. A lot of VCs last couple months ago met in San Francisco to talk about how they can do more of these. In my firm, we're asset managers, and what we say is you can either be an asset manager or an investment bank, but you can't be both without having conflicts of interest. So I think that's what you're going to see more of. So.
And we certainly saw some conflict of interest when it came to WeWork and the co-founder and the former CEO, Adam Neumann, and he got a $1.7 billion golden parachute after, obviously, and then a lot of layoffs and everything else with the company. So how are startups going to calm investor worry about some of these clauses that are kept quiet?
I think you probably mean more of an outrage, right? I think everyone was really mad about that. I think you calm investors by having a proper really business model, and I would argue actually that the fact that they went public or went through the IPO process at least is why we found out all the issues that they had. So I think having those rules and those disclosures and the ability to really understand how the business works is really what allowed us to know all the problems that happen. So for founders today, they're trying to that are successful, going through the IPO process will allow them to really tell people that they have good business or they have viable business to be invested in. So I'll argue that was a good thing, actually, that we found out before the IPO.
Certainly some lessons learned there. Thank you so much. Hatem Dhiab there, managing partner at Gerber Kawasaki.